In this video, I go over two topics from Chapter 2 regarding authoritative guidance for auditing. So we know that with authoritative guidance, this is how we make sure that we have some rules to follow. So two sources of rules, actually there are many, but two sources of rules I would like to go over. First of all will be generally accepted auditing standards, and second, about AICPA membership. So let me cover generally accepted auditing standards first. These are also in your book, starting on page 34. Now in your book, the book talks about these as being AICPA principles underlying the audit, and they're not very concise about them. So I have a much more concise source, which I will be showing you. So if we look here and see under Roman numeral 1 in Chapter 2, we see that all the SASs, or statements of auditing standards, are based on the principles underlying an audit under generally accepted auditing standards. So here's another acronym for accounting, GAAS, just like GAAP. So I say here that I will distribute them on a separate handout. However, I will switch to another screen in a moment. So in the narrow sense, we would refer only to these statements as GAAS. However, in the broader sense, GAAS tends to refer to all the SASs as well as to these statements. Basically, GAAS means we did everything right. So if I come here to the book, first of all, let me show you where they start on page 34 with the same sort of deal, except in much more wording. It's here in figure 2.2. So if this helps, so be it. If not, again, I have a much more concise version for you. The concise version is all you will need. So if we look at AU section 150, generally accepted auditing standards, and this is from the AICPA from the root source, I'm going to scroll down here to where it says auditing standards, and I'm going to see 10 very general precepts that underlie the audit. These are intended to be very general. They can be applied to most anything that we have in the audit. So first of all, we have three different sets of standards. We will have the general standards first, then the standards of fieldwork, then the standards of reporting. By the way, the link to these I sent in the email to you. So first of all, general standards, what generally underlies the auditor's work. And these are easy to understand. First of all, the auditor must have adequate technical training and proficiency to perform the audit. So we have to have technical training, such as we're getting in college, and also proficiency, so experience, expertise. Then, the auditor must maintain independence and mental attitude in all matters relating to the audit. So we know independence, we must be independent in mental attitude, sometimes called independence in fact. It is not sufficient to be simply independent in appearance. Then, the auditor must exercise due professional care in the performance of the audit and the preparation of the report. Due professional care, sometimes shortened to due care, means we do everything we should. We follow all the rules. We were not negligent. Then the standards of fieldwork, underlying the auditor's work in evidence gathering, often out in the field on clients' premises. So first, the auditor must adequately plan the work and must properly supervise any assistants. That one's very straightforward, planning and supervision. The next one is 2. The auditor must obtain a sufficient understanding of the entity and its environment, including its internal control, to assess the risk of material misstatement of the financial statements, whether due to error or fraud, and to design the nature, timing, and extent of further audit procedures. So if things are good, that's wonderful. We can do less audit work because probably the financial statements are okay. If things are not good, we must do more audit work because there are probably some problems. Then number 3, the auditor must obtain sufficient, that means enough, appropriate, that means good quality, audit evidence by performing audit procedures to afford a reasonable basis for an opinion regarding the financial statements under audit. So we must have enough quality evidence. So those standards of field work, again, I think are pretty easy to understand. The standards of reporting are not too bad. They will be even more understandable once we cover Chapter 3, because these underlie the audit report. So first, the auditor must state in the auditor's report whether the financial statements are presented in accordance with generally accepted accounting principles. That one's straightforward. The next one is 2. The auditor must identify in the auditor's report those circumstances in which such principles have not been consistently observed in the current period in relation to the preceding period. So if there's been a change of accounting principle, such as from units of production depreciation to straight line depreciation, we will see how in Chapter 3 we must bring out the audit report. Then number 3, when the auditor determines that informative disclosures are not reasonably adequate, the auditor must so state in the auditor's report. So regarding footnote and parenthetical disclosure in the client's financials, if it is adequate, we say nothing. So no news is good news. If it's not adequate, we will bring out what should have been disclosed. Obviously, nearly every client is going to disclose that finally before the end of the audit when we tell them what we're going to do. But anyway, more about that in Chapter 3 as well as the last one. This one's a bit longer. The auditor must either express an opinion regarding the financial statements taken as a whole. So all the financial statements taken together, we will give an opinion about them. Are they fairly stated in accordance with GAAP or not? Or state that an opinion cannot be expressed in the auditor's report. Sometimes we can't. When the auditor cannot express an overall opinion, the auditor should state the reasons therefore in the auditor's report, and we will see that again in Chapter 3. In all cases where an auditor's name is associated with financial statements, the auditor should clearly indicate the character of the auditor's work, if any, and the degree of responsibility the auditor is taking in the audit report. So we will see that once again in Chapter 3. Now, if I come back to the notes, the next thing I would like for us to take a look at regards quality control for auditing. And again, this is some authoritative guidance. It's how we make sure that we follow the rules and have quality audits. So if I come to B under Roman numeral 2, I need to talk about AICPA membership. So most CPA firms that are of any size are AICPA members, and they want to make sure that they don't violate any rules here. So one way in which the AICPA controls quality is through its membership requirements for CPA firms. And a firm can be a member of either or both sections, 2 sections of the AICPA. Well, the way it works is the firms having at least one SEC client must be a member of the Center for Public Company Audit Firms. So public, if you audit a public firm, you must be a member of the public section. Then all CPA firms can be members of the private companies practice section. So the private companies practice section is geared toward auditing privately held companies. Well, as you can guess, membership in the public section of the AICPA is more stringent. So more rules to follow because public companies have greater business risk for the auditor, concept we'll study later in the course. So first of all, CPA firms who are members of either section must comply with 6 elements of quality control that we can see in Table 2.3 on page 39. Let me look at that with you. So here on page 39, in this table, everybody must comply with these elements of quality control. First of all, leadership responsibilities for quality within the firm. So what's the tone at the top of the CPA firm? Are they committed to running a tight ship with good quality or not? Well, they certainly should. So a summary of the requirement is the firm should promote a culture. The quality is essential in performing engagements that should establish policies and procedures that support that culture. We see an example of a procedure is the firm's training programs emphasize the importance of quality work, and this is reinforced in performance evaluation and compensation decisions. So everything must be quality is what that's saying. Then relevant ethical requirements. So summary is all personnel and engagement should maintain independence in mind or in fact and in appearance, perform all professional responsibilities with integrity, and maintain objectivity in performing their professional responsibilities. An example is that each partner and employee must answer an independence questionnaire annually, dealing with such things as stock ownership and membership on boards of directors. Because if you own stock in a client, or if you're a member of a board of directors, you are no longer independent and cannot do the audit. Then acceptance and continuation of client relationships and specific engagements. Well, we never have to accept a client if we don't feel comfortable. And second, we do not have to continue a client, an existing client that is, if we don't feel comfortable. So we see here a summary of this is the policies and procedures should be established for deciding whether to accept or continue a client relationship or a specific engagement. These policies and procedures should minimize the risk of associating with a client whose management lacks integrity. The firm should also only undertake engagements that can be completed with professional competence. For example, if we do not have experience in banking and a bank comes to us wanting an audit, that is a very different type of industry. We don't have the professional competence for that, and we should say no. So then we see an example of procedure is a client evaluation form, dealing with such matters as predecessor or previous audit or comments and evaluation of management must be completed for every new client before acceptance. We'll see that a few chapters down the road. Then human resources. So policies and procedures should be established to provide the firm with reasonable assurance that we see that all new personnel should be qualified to perform the work competently, otherwise we don't hire them. Then work is assigned to personnel who have adequate technical training and proficiency, so somebody who's ready for the work. Then all personnel should participate in continuing professional education. We'll see that in just a bit, and professional development activities that enable them to fulfill their assigned responsibilities. And then personnel selected for advancement have the qualifications necessary for the fulfillment of their assigned responsibilities, so we don't move them up until they're ready. And then we see a summary of requirements to evaluate all professionals on an ongoing basis. Then engagement performance. All policies and procedures should exist to ensure that the work performed by engagement personnel meets applicable professional standards, legal and regulatory requirements, and the firm's standards of quality. An example of this is that the firm's director of accounting and auditing, there should be someone, is available for consultation and must approve all engagements before their completion. Then finally, monitoring. Policies and procedures should exist to ensure that the other quality control elements are being effectively applied. Well, in a firm, there should be a quality control partner who's in charge of testing quality. So this partner must test the quality control procedures at least annually to ensure the firm is in compliance. So once again, everybody, both private and public sections of the AICPA must comply with those. Then, if we read on starting in the second sentence, everyone, they must also adhere to continuing professional education, 120 hours every 3 years, as well as either peer review for firms who do not audit issuers. That means another CPA firm comes in and looks at some of our audits. Our quality inspections by the Public Companies Accounting Oversight Board for firms who audit issuers or privately owned companies. Again, membership in the public section is more stringent because there's more business risk with an SEC or publicly traded client. And don't worry about the rest of that. Coming on down to, first of all, someone, excuse me, who is in the public companies section must have periodic partner rotation. After 5 years, the partner in charge of the audit must rotate off and cannot come back for 2 years. This way we get a fresh look at that client. Then review of each audit by another designated partner before it's finalized. That is often called a concurring partner. It's someone else, another partner, who looks the audit over and agrees with everything before it goes out the door. Then third, prescription or prohibition of services which will impact independence, including bookkeeping. Can't do bookkeeping for a client recording its transactions. Internal audit services. They can outsource those to another CPA firm, but not to the CPA firm who does their external audit. Certain types of consulting services, especially those related to internal control, because then it's almost like we're auditing our own work. But again, they can outsource that to another CPA firm if they would like, as well as anything related to an audit which includes a contingent fee. A contingent fee is where the auditor gets a higher fee if something happens. We can never do that in an audit. A worst case scenario would be that we get a higher fee if we give a clean opinion. In the audit report in Chapter 3, that's the one that everybody wants. It says things are okay. Contingent fee there would obviously impact independence. Then we must report on disagreements with the client. We also have to footnote that in the financials and in Form 10-K. That's the form of the annual financials, which is filed with the SEC. Well, no client wants disagreements with the auditor. It's a red flag of trouble. So normally we see that there were no disagreements. Then, reporting on management consulting services performed. That way we make sure that the client has not violated anything here. And then, as we discussed, don't worry about number 6. Okay. So that's all I got to tell you here. And thank you. Let me know if you have any questions.